Hi, everybody, and welcome to this podcast. We're going to highlight the contents of our February 2021 PetroLogic report titled Getting Back to Normal. I'm Judith Dwarkin, and with me are Morgan Kwan and Bill Farren-Price. Our message this month is essentially unchanged from last month. We're constructive on crude oil prices for the rest of this year, and particularly in the second half, we're more constructive than the strip at present. Recovering oil demand, flat to declining non-OPEC supply, and continued OPEC plus production cuts are all supporting prices. We're currently in the third quarter of a global stock draw. Our working hypothesis for now is that if prices continue at their current level or even continue to edge up, Saudi Arabia will end its supercut in March as scheduled, and the rest of the phase 3 taper of the OPEC plus agreement will be implemented. We also anticipate the prospect for some weakening compliance across the OPEC plus contingent in the second half of this year as prices are higher. So we're looking at more barrels coming into the market, but we expect the market will be able to absorb these barrels, but it will mark a pause in the price rally. But we do believe prices will still be at a level that's comfortable for most of the key OPEC plus players. By the end of the third quarter of this year, our projections indicate OECD petroleum stocks could be back to normal. However, the problem is that around this time, we also are thinking there could be signs of life in non-OPEC liquids production, particularly in the US. And the problem is that our current expectations for growth here next year could put pressure on OPEC to resume its production cuts if their goal is to sustain prices in the level they may become accustomed to during the rest of this year. One area we want to highlight in this month's report is the path forward for U.S. liquids production. So I'm going to pass the mic over to Morgan to fill you in a bit more detail on that front.
Thanks, Judith. So one of the major differences between January and February is our outlook on 2022 exit-to-exit production. One thing to really keep in mind is the January production numbers really was an unconstrained scenario. So it wasn't bounded by cash flow reinvestment. And one of the things that we've been baking into the model this February is what operators have been disclosing for guidance numbers and what their reinvestment targets are. And so really they're using a $50 WTI and a 60 to 70% reinvestment rate. And with those boundaries, we just don't expect to see the same rebound in production that we modeled in January. So moving now to a 2022 exit production number of 540,000 barrels per day growth. So we're still expecting growth, but not to the same extent that we originally anticipated in an unconstrained scenario in January. And this certainly is the biggest risk to this U.S. supply forecast. As prices improve, if we see that strip improve beyond where levels are today, just what that operator discipline is to sticking to those reinvestment rates and dividend programs that they've stated for 2021. If we see improved cash flow, how disciplined they will be to sticking to that. So with that, maybe I'll hand it back to Judith.
Thanks, Morgan. The other area we want to highlight for this month relates to Iran. As you know, nearly 2 million barrels per day have been sidelined from that country because of the U.S. sanctions. And our price scenario assumes that these barrels don't return in the near term, or if they do, that others in OPEC step aside to avoid crashing the market. So I'm going to pass the mic to Bill Farren-Price to maybe speak to more recent developments with respect to U.S.-Iran relationships and where we think things may go from here.
Thanks, Judith. Yeah, it's been a choppy period in US-Iran relations. Going back to 2015, we had the nuclear deal that was crafted by the P5+1 international negotiators with Iran and allowed Iran to export oil as long as it was compliant with this nuclear deal. And when the US pulled out of the deal under President Trump, that meant that Iranian oil exports basically declined to very, very low levels. So we now estimate that there's about 1.7 million barrels a day of pent-up potential export from Iran that could come back on stream, and obviously that has a material difference, would make a material difference to our balances. So what is interesting is that, as we wrote back in October last year, a priority of the Biden administration has been to reinvigorate multilateral agreements and international organizations. And part of that is the determination of the new US administration to rejoin the Iran nuclear deal. However, there are some hurdles that have to be negotiated on the way to this. One of them is that Iran is no longer compliant with the nuclear deal. It has curtailed some of the UN inspections of the International Atomic Energy Agency, and it has also started to enrich uranium to higher levels than are allowed under the deal, and maintain higher levels of uranium stocks than are allowed under the deal. So Iran has some way to go to come back into compliance with the 2015 deal. Similarly, there is now a standoff, if you like, between Iran and the US on who will move first. Iran arguing that the US should lift sanctions before it comes back into compliance, and the US arguing, unsurprisingly, that Iran needs to come back into compliance before it lifts sanctions. However, there is fairly good evidence, not least a recent short-term deal on inspections that Iran has agreed to, that the mood music is slightly more positive towards some sort of deal. And I think it would be reasonable to say that we should watch this file carefully, because it's quite possible that we get some kind of breakthrough in the next few weeks. There are issues around Iran's domestic politics that need to be taken into account as well. We know that, for example, Iran has presidential elections scheduled for mid-June, and we are in a bit of a period of a lame duck presidency for Hassan Rouhani, and it may well be that a deal doesn't get done until after those elections take place. However, there is movement, and it is worth watching this carefully, because the return of these Iranian barrels to the market will have a big impact on OPEC, on our global balances, and make a significant difference. So that's the situation as it stands, Judith.
Thank you, Bill. And so, folks, I hope you've found this sneak peek into our current thinking about the near-term dynamic in the global oil market helpful. Please don't hesitate to reach out if you'd like to dive into things more deeply once you've read the report.